Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Fidelity's US equity factor ETF model portfolio. Now, what we would expect from this portfolio is simply to get certain factor exposures. And if you look at the fact sheet of this model portfolio, it does highlight attractive or enhanced, specifically risk-adjusted returns. So we're looking for a high Sharpe ratio. So let's kick off in terms of reviewing what's actually in this portfolio. And we can see this is effectively 6 Fidelity ETFs that each charge between 18 and 19 basis points. We do see there's also a 2% allocation to cash. If you look at the largest allocations, this is to momentum 25%, value 25%, and quality 20%, and also low vol, multi-factor with small mid cap, and high dividend. So effectively, you have a little bit of everything in this portfolio from a factor perspective. Now, if we benchmark that, we do see that the kind of suggested benchmark from our tool is the Russell 3000 index. And we can compare the performance of this Fidelity portfolio with the Russell 3000, since 2019. And we do see, a slight underperformance. You can also see the trends are almost identical. That is to be expected because this is an all equity portfolio comprised of US stocks, so quite similar to Russell 3000. Now, let's investigate actually in terms of how much factor exposures we're getting. And we can look at the betas to asset classes, but in this case, this is effectively quite straightforward, that effectively you have no exposure to other asset classes because it's an equity portfolio, and your beta is close to 1 to the S&P 500. Now, moving to equity factors, what we do see here is almost consistent positive exposures to kind of like the popular factors in the sense of value, momentum, low vol, quality, and size. And that is expected given that if you look at the holdings again, we effectively see these ETFs that provide exposure to those factors, right? So that's all well. Having said that, the betas here are quite small from a magnitude perspective, which just stated differently means the factor exposures are minor. And if you look at a risk sources analysis, effectively you can see that over the last, almost 5 years, the exposure to equity factors almost contributed nothing. Almost all the risk is simply stock market risk. And that's something that we frequently point out, right? Especially with defensive smart beta strategies like quality or low volatility, that it's still primarily stock market risk is really getting. So this is with regards to this portfolio on a standalone basis. Now, the kind of question that we usually ask at this point is this portfolio thoughtfully constructed? And the short answer is no. And the reason for that is that there's just too much going on in this portfolio, in a sense that we are throwing in like multiple smart beta ETFs that have conflicting factor exposures. So let's make an example. So we can see, for example, Fidelity value factor has a 25% allocation, and we can look at the beta to the value factor, which is positive, as expected. But then the problem is that we have these other ETFs in here, the quality factor ETF and the low volatility factor. And if we go back to the exposure to the value factor, which is up here, we can see it's negative, negative. So effectively what happens is, you can see this for the value factor, positive, positive, negative, negative, positive, positive, but on portfolio level, it's minor or almost insignificant. So effectively you have too much factor offsetting happening, which effectively kind of like mitigates the point, right? It would be better to have either one fund that uses the intersectional model to select stocks, right? That's a better way of doing that, or just to have fewer smart beta ETFs in here. Now, the other question that we can ask is, can we reduce fees? And the short answer is yes. There's almost always a fund that is similar but cheaper. In this case, for example, the Fidelity low volatility factor ETF charges 18 basis points. You can buy a very similar product from Vanguard that charges 13 basis points and you save 5 basis points per annum. If you do this on portfolio level, effectively replace all of the existing ETFs with cheaper but similar but cheaper versions, we can see we can bring down the cost from 18 basis points to 6 basis points. And kind of interestingly is that this cheaper portfolio, i.e. the yellow line, actually did slightly even better, right? So you save money and you get a better portfolio. Now that's with regards to reducing fees. We can also ask the question is, can we simplify that portfolio? And we know this portfolio has 6 ETFs and it has 2% allocation to cash. You can effectively replicate this portfolio simply by allocating, well, a tiny bit to, ironically, a Fidelity product that gives exposure to industrial stocks and the Russell 3000 with 86%, which doesn't reduce fees. Both portfolios charge 18 basis points, but effectively you're getting something that's much simpler, 2 securities instead of, well, 7, right? And it's simpler. So this is a quick review of Fidelity's US equity factor ETF model portfolio, which is kind of a mouthful. And as you can see, this portfolio provides you factor exposures, but the problem is that there's too many factors that have been added, and effective factor offsetting occurs. And so you can easily reduce costs or simplify, right? There's nothing particularly unique about this. Hope that helps. Have a nice day.